the news on EquityAxis, your cross-section of the stock markets and of developments in the Zimbabwean economy. A beautiful evening it is to you. Thank you for joining us as we broadcast live from Hampton Studios in Harare. I'm Ibn Mabunda. Let's get into business. As the fuel crisis intensifies, some fuel stations have shut down while most adjust their prices north of $7 per litre. Following these developments, Zera has issued a statement stating that they have not sanctioned the fuel price increases. Late this afternoon, social media was awash with images as well as reports of the fuel price increases that have hit the market. Now let's just have a look at some of the responses that have been issued from Zera as well as other players within that field. Well, this is Nick Mangwana saying Zera seemed to hold a different position to what has been playing out, and Zera says, following the post circulating on social media on the increases of fuel prices, Zera wishes to assert that fuel prices have not been reviewed. And here's another tweet from the PEMSEC for Finance, George Goamatanga, who says, the government has not increased the price of fuel. While a review of prices was done, the decision is that the current prices should be maintained. Zera will be issuing a detailed statement, which is what we just read. And now this is the Minister of Information following a cabinet briefing, and they said it is unacceptable for fuel players to insist on US dollar payments that is not compliant with their licenses, and of course that was in line with the pricing that we're actually seeing playing out. And then it says that cabinet has resolved that it is unacceptable to sell fuel at as high as $7 per litre. Minister Fortune Chassis has met players and warned that this behavior is not acceptable, and Zera Energy will be out in full force enforcing the law. So a threat there from government if this persists, but let's see if the fuel will be available at the fuel pumps tomorrow. Meanwhile, the prevailing harsh macroeconomic setup has affected the local mining sector, with declined output recorded across all minerals except for chrome in the first quarter of 2019. Coal production slumping 43%, diamond production losing 49%, while gold production declined by 10%, chrome increasing by 2%. As we make progress, Sibanye Stillwater completes the takeover of platinum producer Lonmin in a deal worth $286 million to create the world's second largest platinum producer behind Anglo American. This follows shareholder approval in both companies between Monday and Tuesday afternoon. Sibanye has a dual listing on the Johannesburg as well as the New York Stock Exchange, while Lonmin is listed on the London Stock Exchange. Shares in Lonmin as well as Sibanye went up 7% in response to the move, while Sibanye of course has a 50% share ownership in Mimosa alongside Amplats, which also has a 50% stake in that particular corporation. As we make progress, wheat output increases by 1.3% in 2018 to 160,000 metric tons against the 158,000 metric tons recorded in 2017. This was despite a 22% decline in hectareage under wheat farming. Zimbabwe demands 400,000 metric tons of wheat annually, with the balance of the requirement being sourced from beyond our borders. Now let's get into the stats so that we see how Zimbabwe has performed with regards to the production of wheat over the past few years. Well, according to the stats that we have, we hit our peaks in about 1990 as well as 2000, where we hit north of 300,000 to about 325,000 thereabout, and now there was a decline from 2007 2008 to quite minimal low levels at about 20,000, and now we are hitting at about 160,000. So this is how it has played out. I mean, issues there that have affected the production are issues to do with mechanization, among other things, and thanks to Command Agriculture, we seem to actually be recording positives in that particular regard. Well, this concludes our evening news bulletin. Up next is a news review. Please stay tuned. Welcome back, viewers. It's now time for news review, and with me in set is our very own chief analyst, Respect Gwenzi. Respect, good evening and welcome to the show.
It's my pleasure, Eben. Thanks for inviting me. Good evening, viewers.
Fantastic. Let's cut to the chase.
Sure.
Bread and butter issues, wheat scaling 1.3% in terms of the output there to 160,000 against a national demand of 400,000 metric tons per year. What is your assessment of the figures that we have just been presented with?
I think if you look at the variance between what we demand and what we are able to supply from the local produce at 160 as per 2018 aggregate production levels, it shows that we still have got a wide variance between the supply and the demand gap, and that essentially means we are in for further importation of the produce. But I think when you look at the implication in terms of our day-to-day life or our bread and butter issues, I think it essentially means the price of bread will continue to be subjected to these market fluctuations, especially now that the exchange rate has been liberalized. So we are likely to see the price of bread also responding to such dynamics. Why? Because importers of wheat will have to buy the dollar on the market, and given the current trend of the exchange rate, it means we are obviously likely to see growth in the price of bread. But I think as well, if you look at the overtures that were being the attempts by some of the producers, either of bread or some other products, they have been involved in contract farming, and they have tried to increase the hectareage under wheat production in Zimbabwe, but that is not really yielding much in terms of good return. Why? Because of the net impact of pricing. Why? If you are to produce a certain product, or if you are to grow a certain product, then you have to have a viable price that covers your cost. So wheat is one of those products which have not been viable in terms of actual production. Why? Because we failed to beat the hectareage. That's the yield per hectare which is needed to earn a certain favorable prices. So of course, yes, there have been support for the sector. There has been a drive to try to push for contract farming in that respect, but it's not yet yielding desired result. A growth of below 2% is not something that I would call huge or something that's worth writing home about.
So are we likely to see sustained price increases where bread is concerned?
This is a function of the exchange rate, but what's clear is that the price of bread will continue to be dictated by the direction, by what happens within the interbank. Why? Because over half of what we demand in terms of wheat still has to be purchased through importation, and imports are a function of foreign currency. So that means that volatility will have to affect the price of bread. But to say that the price will go up or down, I think it depends with how one sees the rate playing out in the near-term outlook. But the current trend is that the exchange rate is going up since the liberalization. The pace has even quickened, and so obviously the price of bread has to respond as well in that respective direction. So if fundamentals correct, then maybe we might also see a correction downwards of the price of bread as well. But in the current moment, it's actually an upward growth in price.
Fair enough. Now, we get much of our forex through minerals, and now in the first quarter of 2019, across the board, you would find that there has been a decline with regards to the output. For diamond, coal, gold, and for several other minerals, just to name a few. Just one maybe significant one, chrome, which has scaled to 2%, but across the board, there has been a decline in terms of the output. What does this mean for Zimbabwe going forward?
That's actually a telling situation. It shows you what the underlying situation is like in terms of the macroeconomic environment. Essentially, minerals are exported outside Zim, so they are not subjected to local market forces in terms of demand and supply. Why? Because we essentially produce to export, so it's subject to what happens elsewhere in the world. But in terms of supply, this is the side of supply is dependent on some some macro developments, issues to do with the exchange rate, issues to do with availability of forex on the interbank now and back then, allocations by RBZ. Obviously, these are factors which miners have been concerned about. They haven't been able to really retool, and some of them have not get a full value out of their produce due to exchange rate losses. And obviously, the dynamics around the shifting currencies and also liquidity issues, inflation, and so forth have obviously led producers to scale back a bit and to have to get into a situation where they try to see how the market turns out to be, what policies government implements, and they then respond accordingly, but on a more cautious path. So I would say this is quite reflective of the fundamentals. There's been a shift in policies over the past few months, and obviously you need to be pragmatic, you need to be cautious in how you approach the situation. But essentially, when you look at key minerals like gold, which accounts for over 20% of our foreign earnings, you realize that the retention ratio, the retention of 50, has not been as welcome to producers. So obviously you would try to cut back on your production just to preserve value of your mineral, hoping that at some point the correct government will pay the right price for the produce, or maybe the full product will not be subjected to retention levels. I think these are some of the tactics that producers are using to preserve value and to protect their mineral, on the ground. So obviously it might have spread across other products as well. But when you look at chrome, this is basically a mineral which previously its exportation in raw form was banned by the government, and government lifted that ban only last year. And if you see the kind of investment which has come into that sector, so it's quite significant since last year. So obviously it's coming from a very low base, and also given this new regulation, it obviously inspired increased production and exportation of the produce. But all other minerals which have been there, they are obviously pointing to downwards in terms of production, which I think is reflective of the macro environment.
Going forward, what can we expect?
I think what miners and general exporters are demanding for at the current moment is a full value of they want to get full value of their produce. They want to export and to get their earnings in real dollars, and they also don't want to be forced to cede their earnings within that 30-day moratorium. And some are not even favoring the 50% retention levels. Why? They believe that the difference which they cede at the interbank rate is not reflective of the true value or the true opportunity cost, given that the black market or the parallel market rate is quite up there. So they feel that the exchange losses which are associated with selling their produce, with foregoing their funds using the interbank rate. So I think these challenges, they're likely to remain with us in the very short term. Obviously, government is moving towards liberalization, which means they might also push back in terms of the retention levels that they're demanding from miners as well. So I think once the interbank market starts to reflect real market forces and obviously go up to those desired levels, I think that's when we might start to see producers being confident to produce and even to export as well. So that might run at least in the foreseeable future up until Zimbabwe stabilizes, especially on the macro side and on the monetary side.
I realize. Now let's talk about the fuel issues that continue to embattle the country. It's been several weeks, if not months, of fuel issues, fuel concerns, fuel hikes, even resulting in demonstrations. And up to this point, where we are saying that just last week, RBZ removed that 1:1 subsidy that was there for in terms of the fuel pricing. And now there are talks of fuel shortages on the market, as well as new pricing that is coming from the market side. Now Zira comes in and says, look, we have not sanctioned this particular development in that regard, and they continue to dismiss such claims. What is your comment where the progression of things where the fuel sector is concerned?
I think I'm on record regards this matter, highlighting my views in terms of what should be done and in terms of the pricing of fuel. When government chose to liberalize the exchange rate, that is a week ago, what that did is to obviously push fluctuations. It means fluctuations are coming at a faster rate. Why? Because previously, when the rate was controlled, the price gains were quite marginal. Now that there has been more space for the exchange rate to move, it means there are bound to be those fluctuations. And at the same time, they come on board and say, we are going to remove subsidies in terms of fuel importation and other goods. And they peg the price of 4.9, arriving at it after factoring an exchange rate of 4.6 times. Okay. What that does is to say, when the price, when the exchange rate moves ahead of 4.6, then essentially the price of the product also has to move upwards if we are to maintain last week's levels of margins. Unless if you are saying maybe you have to forego your margins and possibly even sell at a loss, then you have to maintain your prices. So you cannot liberalize the exchange rate and yet control the price of fuel in the market. Why? Because the price of fuel is also subjected to the exchange rate. Because those who import, they are importing at a certain rate. So as of last week, they were getting monies at 4.6. As of today, they are getting money at 5.07. And it means they have to adjust by that same ratio. It's I think it's grade 7 mathematics, if I may say. You say, obviously, if 4.6, at a rate of 4.6, you could buy 4.9 worth. How much do you buy when your rate is now 4.09, 5.07 thereabout? Obviously, if you do the math, it means this has to increase in a way if you are to maintain margins. So yeah, I think it's ill-advised for government to try to now put their hand and stop prices, whereas they have stopped influencing the market rate as well.
Looks a policy conflict somewhat.
Yes, there's definitely a policy conflict. Unless you are going to give them at 4.6, then that's cool. But if you're not going to give them the foreign currency at 4.6, it means they have to adjust their prices accordingly. And those are not the only costs that are involved in fuel. You have got your electricity, you've got your other costs, with regards to employment and whatsoever. All these variables are moving in line with developments in the macro economy as well. So, fuel suppliers have to adjust their pricing as well in line with these other developments. So what has happened today essentially is a clear it's a clear reflection of government's indecision on whether to pursue market forces or to maintain a command structure where they influence the rate of the prices of fuel and even the exchange rate as well. So I think there's a real dilemma in government's mind, but on the other hand, I think I quite understand how they also think of fuel or deduce in terms of these whole things. Once you let the price of fuel go up, essentially it means inflation is likely to push at an even faster rate. Of course, we know that last week fuel went up and prices are still adjusting in the market. Prices are going up. And so government knows that it's another round of price blitz and they don't want such a situation. It's not good for politics. It's also not good for business viability. So they're trying to manage sentiment and also trying to accommodate market fundamentals and so forth at the same time, market forces at the same time. And this doesn't work hand in hand. They'll either have to choose to command the economy or let market forces be at play. And when you do that, you bring clarity to the matter, and we know that we are either in this side or that other side.
I realize. Now, yesterday the Minister of Finance said, look, government is not going to increase the prices of tariffs for
electricity.
Yes, and now with them actually controlling the ZESA side of things, are they likely to come in or hard on fuel? Or
I think what's happening on the electricity side is it gives us a clearer picture of what it means to control fuel. They've actually cut back significantly on the importation of electricity over the past few months. But the resultant effect is that there's no electricity in our homes and at our workplaces. And that obviously affects production, productivity, and on all that. So now that now that government wants to control fuel in terms of its pricing, it means the importation of fuel will also slow down. And once the importation slows down, it means it sustains the market gaps or the shortages that are readily there in the market at the present moment. So I don't think that they are controlling the electricity side per se. They are simply thwarting demand, but by so doing, there's an opportunity cost of lost production. And I think that is clearly not sustainable.
I realize. Well, thank you for the perspectives, respect. Thank you, viewers, for watching. Up next is a look at the stock markets. Please don't go anywhere. Welcome back, viewers. It's now time for Markets Daily, and with me in set is our very own investment analyst, Anesu Chumbumo. Anesu, good evening and welcome to the show.
Thank you, Eben. How are you doing today?
Fantastic. Yourself?
I'm all right. Thank you.
Just
a little bit elated about what is happening on the stock market lately. Now, the stock market is now up 6.92% on the all share and industrials index on a day-on-day basis, coming up to 176.81 points, and the industrial index settling at 591.51 points. Now, the mining's index did add 4.29%, and then the top 10 index is up 8.81%, resultant of 9 counters within that index moving northwards, and only Padenga letting go of its prior session's gains. Now, Econet and Cassava as of late have been leading that pack of top 10 counters on the stock market, coming up 14.91%, and Cassava is up 12.62% at 170.49 cents, while Econet is 162.12 points. Now, the next best performing counter for today in the top 10 index was Citco International, which is at 10.37%, which added 10.37% for it to settle at 165 cents. Now, Citco International is also listed on the Botswana Stock Exchange. The Zim Stock Exchange is a secondary listing, so it may be one of another avenue for most of the investors within the Zim market finding a way out, just like they do, and some of did with Old Mutual. Old Mutual did add 1.18%. Now we only have 4 counters that are left in the red on a year-to-date basis, which are notably your Citco, your Nat Foods, which had been stable for quite some time, did add 2.04%. Now, if you just move quickly into the next chart here, where we have a realization of who really is pushing the market. Like today, top 10 index is up 8.8%, and it has shown again its dominance on a week-to-date basis, coming up 21.73% for it to settle at 173.32 points from last week's closing session of 142.38, while the miners index is up 2.6%, resultant of today's movement. Now, your all share index and the industrials index do show some strong strong movements there, showing how we have a very wide market selection. It is not only spread out into the top 10 stocks, but also into mid-tier and penny stock counters. Now, we had a very wide market breadth today, with about 21 counters appearing as bulls, while three counters were bears. Now, among the three counters that were bears, Zim Papers was the weakest performing counter of the day, coming up 11.31%, for it to settle at 8 cents, while NMB and Padenga did trail that to cap that set of top three rises. Now, Bindura Nickel Company did add 17.33%, which is the resultant, which is the cause for your mining's index going up today by about 2%. Now, Econet and Cassava, we've spoken about those quite frankly. FMP is up 12.07%. Mash Holdings also up 11.08%. Both counters are within the same sector within the economy. Both are in properties. Mash Holdings is now only beginning to move into and venture into a new territory for them, into new business territory for them, in terms of tourism, in terms of tourist properties. Now, FMP has had some hand in there. They also are making sure that they have a firmer hand within their tourism, within the tourism sector, by having properties in Vic Falls. Now, these two counters may be somewhat of an interest for a lot of investors because of how the property market has led the change in terms of what currency is widely used on an unofficial basis, which is pretty much the US dollar. Now, the US dollar has been very much accepted widely on the property market, which has pretty much slowed down how volumes have been moving on that market as of late. I mean, you don't have a lot of people who are earning US dollars who have the propensity to actually spend such huge amounts of US dollars in terms of property purchases or actually rentals. So that market has slowed down in terms of volumes, but then it was only right for that market to only move into the US dollar phase for preservation of value in a very eerie economy. Now, an eerie economy, as we've spoken about, I've just mentioned. Today we did realize that there were some statements. I'm sure you and the Spectre already have discussed about that. Much to do with how fuel prices are supposed to be going up. I would like to really qualify my statement there, as I said, are supposed to be going up, because like me and Respect did talk about yesterday, when the interbank rate was at about 4.95, we did realize that fuel retailers are going to be making losses if they maintain the price that they were at. So this would only push them to actually move in the same direction as the exchange rate is moving, which would be northward. So they could be only justified for them to move northward as much as they have done, to about 7, which is a lot more, which is somewhat something that is being reflected on the apparel market and the old mutual implied rate, in terms of what kind of exchange rate they would like to prefer using in actual fact, because right now the interbank rate is at 5.07 as of close of business today, while the old mutual implied rate and the apparel market rate did inch up to go to about 7.62 and 7.1 in that respective order. So with those weakening exchange rates, fuel prices are only supposed to go up, and that inflationary effect that the exchange rate has will push investors into the stock market, as they already have been.
Well, thank you, Anissa, for the perspectives. Thank you, VS, for staying with us. Don't forget to like, subscribe, follow us on Twitter, Facebook, and to visit our website for updates, www.EquityAxis.net. Once again, thank you and ciao.